My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends just trying to make you some money. My job is not just to entertain, but to educate, also teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You know what I thought today as the Dow gained 228 points, bursting through the 27,000 level, while the S&P advanced 0.23% and the Nasdaq dipped 0.08%. I wasn't thinking about the Fed like everybody else. I was thinking that scale, yes, scale is a wonderful thing. What do I mean by scale? A company with scale is a company that's big enough and powerful enough to control its own destiny. A company that scales is one that survives and then thrives in even the toughest environment that a Fed chief is worried about or anybody else who just listens to nothing but Washington. Scale. Simply being bigger than the other guy, a lot bigger, is an enormous advantage. And we saw the benefits play out all day today. Exhibit A. Amazon. It crossed the $1 trillion threshold this morning. $1 trillion. We're giving up some of the gains this afternoon. And Amazon didn't become this unstoppable behemoth just because Jeff Bezos is brilliant, which he is. It got here by leveraging its scale. In other words, Amazon's dominant because it's so big. They use that scale to get better prices from their suppliers, which they then can pass on to you, the customer, undercutting the competition. Apropos of nothing, this is why we have antitrust law, because when you get big enough, well, no one can compete against you. Bezos saw how he could use Amazon's scale to dominate retail, but he didn't stop there. He figured he could do the same thing in cloud computing by creating Amazon Web Services. AWS is one of the largest software businesses on earth, and it's still growing at a 40% clip. It's a marvel. And when we had Andy Jassy, the head of AWS, on the show recently, he kept telling us how his business has scaled to the point that it's the dominant player in the cloud, which is true. That allows him to innovate and keep prices down, drive away the competition. I urge you to go back and look at that interview. I thought it was mind-blowing. I said to myself, darn it, man, that guy is just real smart. Amazon also knows that the secret to maintaining scale is keeping your workforce happy. And that's why Bezos is committing $700 million to retraining workers so they can thrive in this new economy, whether they stay in Amazon or leave for other opportunities. Please read that press release. It's much more than just blather. Came out this morning. You can't win in this environment without human capital. And while that's an extremely creepy phrase, it's still true. Who else benefits from scale? How about the silent trillionaire? How about Microsoft? This morning, Cowen put out a buy recommendation titled A Framework for Microsoft's Next $100 Billion in Revenues. You know, when I looked at it, I said to somebody, I said, oh, $100 million. All right, well, so what? No, $100 billion. Something they predict will happen by fiscal year 2025. That's not that far from now. I'm using this one right now. I switch all the time. I use that one, too. And then this is my wife's favorite. Talk about apropos of nothing. Anyway, most companies never even get to $1 billion in revenues. Here, Cowen's talking about how Microsoft can almost double this year's projected $124 billion in revenues in 6 years' time. It was an astonishing read, and I think it was right. Why? Because Microsoft's going to rival Amazon in the cloud with Azure, its own web services business. Microsoft CEO Satya Nadella has quietly put together a powerhouse cloud division that's growing so fast that it will soon become a larger part of the company than even Microsoft Office. In fact, Cowen believes in the commercial cloud that will account for 90% of that next $100 billion in sales. Guys, come on. I know the stock has moved up tremendously. I know it could give up a couple points in reports this week, but you don't get the $1 trillion for doing nothing. At the moment, only Microsoft has the scale to compete with Amazon here. As you can imagine, there are many companies, including almost every large retailer, though, that refuses to do business with Amazon Web Services, given that Amazon is their mortal enemy. Now, one of the biggest beneficiaries of scale, benefits of scaling, is that it keeps your suppliers in check. And that keeps your gross margins up and makes it so that we like your stock more. And that's the main reason I've created a brand new acronym for the very few retailers that have enough scale to control over their costs and therefore their destiny. Yep, I'm talking about Watch, Walmart, Amazon, Target, Costco, and Home Depot. Watch. I bring this up because it's easy to understand how dominant Amazon Web Services is. You know it powers Amazon Prime. You know it helps them predict when you want what you want before you know it yourself. It's harder to get your head around Microsoft's Azure because it's not oriented around the consumer. It's a business product. But you all know Watch. You all know it. You probably all like them. So how do these companies maintain their scale at a time when most brick-and-mortar retailers seem to be wilting? Simple. They innovate. They change their stripes. They find ways to grow every day. They're brilliant. Let me walk you through them, starting with Walmart. You need to know that Walmart could easily become Sears. The stores were dowdy and unpleasant. They didn't really have an online presence. They paid their workers too little to keep them, and that wouldn't keep them there very long. It was suboptimal. Walmart's now changed all of that. They've got a fantastic web business that will only get better now that Mark Laurie is fully integrating Jet.com. Did you see that interview when he came on? Wow. They pay people more, allowing them to hold on to the best workers, and that made their stores cleaner and brighter and more fun. Yes, fun. Best of all, Walmart can negotiate prices with any supplier at once because they can't afford not to sell into Walmart's channel, which is why I always say that's how you can buy French's mustard for $1. I got a picture to prove it. That's really bad for their supply chain, but oh my, is it ever great for their shareholders. This is a good stock, eh? All right, we covered it already. I am actually going to resist the urge to say more, other than next week's Amazon Prime Day, which is 2 days, and I can't wait. The T is for Target. Oh, I don't think people realize how much CEO Brian Cornell has done to reinvent this company unless you've been to a Target lately. I visited a new inner-city store in Brooklyn, my home, the other day. One of many all over the country inner-city news stores. And I can tell you that the combination of Shipt, which is S-H-I-P-T, their brilliant delivery system, with their fun, even whimsical stores, Yale University. I love that. And great prices is allowing Target to own whole new metropolitan areas that everyone else had given up on foolishly, but not Cornell because he's a visionary. All right, so they only have 30 million customers. Walmart's got almost 10 times that worldwide. You could argue that that means the company's too small to be in this illustrious group. But given how fast Target's growing, I think it's only a matter of time that you won't feel that way. Oh, and don't underestimate their e-commerce business, which is scaling up right now. Stock to own. C stands for Costco. When you have about 83 million people who pay to be members of your buying club, you've got an amazing business. Costco's my favorite club, even more than the Summit Elks. They can raise the price of the cart, as they have several times, and I wouldn't even care. That's how much money I save. I'm jealous that my wife's an executive member, and I'm only a plebe. I am a two-cart guy. When I go, the wife takes one, I take the other. I know that I'm getting the lowest price of everything I buy there. I have seen Zegna shirts, Zegna, at Costco that cost less than what other merchants pay for them wholesale. These people are magicians. Finally, the H, Home Depot. Honestly, close followers of my outrageous Twitter feed, except for when I'm featuring NVIDIA the dog or my garden, know that I didn't initially include the H when I was noodling on my acronym. You might think I only added the despot because watch sounds a lot better than what? But in reality, Home Depot is great at selling merchandise quickly, which is, these are called turns, which is a dream come true for suppliers, allowing them to get terrific deals. Obviously, if you're a tool or garden company and you don't sell into Home Depot, you are dead. Enough said. They can make or break anybody. Now, is it right that we have a handful of gigantic retailers who can bully their suppliers into giving them better deals? Is it anti-competitive? That's not my department. You think I run the Justice Department? I'm here to help you identify high-quality stocks, like watch. Bottom line, as an investor, you need to recognize which businesses can scale, because those are the ones that win, like Amazon, like Microsoft, like watch. Oh, and just wait until those ETF demons take my beautiful, lovable acronym and create a security to profit from it. They did it with FANG. They'll do it with watch. Sherry in New Jersey, Sherry.
Hey, Jim. Booyah.
Booyah, Sherry. What's shaking?
My question is regarding ticker symbol Twitter. So it has fallen from its high of 41 down to 34.5, and now it went back up to around 37. My question is, given the macro scrutiny on social media stocks and the company outlook, do you think
Right.
it's worth to keep it or to sell it?
No, I want you to own it. I mean, I think the quarters could be okay. The stock is a bit of a football. Ned Siegel's been going around telling decent things. Here's the problem with Twitter as I see it. Everybody thinks that because the president uses it all the time, it's a good stock. And that's an interesting but not correct analysis. How about John, Jon, not John, in New York? John.
Yes. Hi, Jim. Love your show, and thanks for taking my call.
My pleasure.
My question to you is about BlackBerry in comparison to CrowdStrike. The stock has taken a beating recently, even though it appears better positioned for excellent growth now that they've managed to transition completely out of the hardware business and into the higher margin software and services business using their artificial intelligence cybersecurity comparable to CrowdStrike's, their QNX security platform for self-driving vehicles, their asset tracking service, and their position in the up-and-coming IoT security market, to name a few. Is BlackBerry a buy at these levels, Jim?
I have been hearing that very well analyzed rap about BlackBerry for too long. In the meantime, so many other better companies, like an Okta, like a Zscaler, like a Zendesk, and just on and on I could go about these, Alteryx. They all have better software, and they've got more than these guys. All right, it's all about scale, people. Scale. Remember that word. It's about which businesses can scale. Watch out for Walmart, for Amazon, Target, Costco, and Home Depot. Oh, man, money tonight. Is it return to sender when it comes to FedEx? I'm eyeing the company's potential for a turnaround to see if we can start delivering profits once again that are bountiful. Then, after plenty of headlines in the cannabis space, I'm eyeing the buds and the duds in the cohort and telling you which plays could be worth the eyeing. And how are you growing exports of U.S. LNG, helping natural gas prices? Do they help them, or does someone make money with it? I know who makes money. Don't miss my sit down with Sharif, Mr. Cashflow, Suke, and stay with Watch and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.